Welcome to your daily Solo 401k webinar Q&A session with my Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic: does a Solo 401k have to be set up before year end? Most self-employed business owners miss the one deadline that can make or break their entire solo 401k tax strategy. And no, it's not the contribution deadline, it's the solo 401k setup slash establishment deadline. Today, we are breaking down exactly when your solo 401k plan must be established, who needs to act before December 31st, and the exception that can save you if you think you are too late, or if you are viewing this webinar for the first time in tax year 2026. So you would be surprised how many people find out in January that they could have saved thousands in taxes in their solo 401k, only to learn they've missed the deadline to open the plan. But here's the twist: not every business has the same deadline to open the solo 401k plan. Sole proprietors, S corporations, partnerships, each one plays by different regulations. So this is your chance to get answers. Use the chat to ask questions on today's topic or any other topic for that matter. Type them over now so that we can be sure to get to them all. Let's get started. Looks like we have a question here already. Looks like I have a questions. Do I have to wait for it? No, you don't. Go ahead and type your questions, and we'll pause and answer those questions as they come in. So again, the topic for today is, does a solo 401k have to be set up before year end? So here we are in November of 2025. If you're listening to this live webinar, then you still have plenty of time to open the solo 401k plan. It's typically best to open it by December 31st of 2025 so that you don't have to try to remember when to open it next year. And as you're going to find out, if you want to be able to make all contribution types, employee, employer, and voluntary after-tax contributions, for most businesses, you need to open that solo 401k plan by December 31st. However, as you're going to find out, some contributions can be made even if you wait to open the solo 401k plan in January or after of 2026. So if you're listening to this webinar for the first time in 2026, this will be good information for you to understand as well. So if you wait to open the plan in 2026 or after, you can typically only make employer and voluntary after-tax solo 401k contributions, not employee solo 401k contributions. There's an exception to that if your business is taxed as a sole proprietorship. And again, we're going to cover that more here today. So again, the rules differ versus a sole proprietorship, an S corp, and a partnership with regards to whether or not you need to set up the plan by year end. So why do the deadlines matter? Well, if you miss the deadline, then you're going to end up not being able to reduce your taxable income for the year or make certain types of contributions. So let's keep covering this topic here. And again, go ahead and type over questions that you have, and we'll pause and answer those questions as they come in. So again, the real deadline to establish a solo 401k is based on your business, your self-employed business type. So if it's a sole proprietorship, while you can establish the solo 401k plan for tax year 2025 by April 15 of 2026, so that you can make contributions for tax year 2025, contributions such as employee contributions, employer contributions, and voluntary after-tax solo 401k contributions. You still have time to open the plan here in 2025. But if you don't open the plan by December 31st of 2025 and your self-employed business is taxed as a sole proprietorship, then under Secure Act 2.0, you can wait and open the solo 401k plan, and you have to fund it by April 15 of 2026 so that you can make all contribution types for tax year 2025 based on your earned income from self-employment activity in 2025. You'll be able to make employee contributions, employer and voluntary after-tax contributions, but you're going to have to make that employee contribution and open the plan by April 15 of 2026 if you want to contribute for tax year 2025. So, in review, if your business is taxed as a sole proprietorship, you can still open the solo 401k plan here in 2025, as you still have a couple months to do so. But if you do not open it in 2025, and you're listening to this for the webinar for the first time in 2026, for example, you can open the plan by April 15 of 2026, and so that you can make employee contributions for tax year 2025. But you're also going to have to make that employee contribution by April 15 of tax year 2026 for 2025. But you'll be able to make employer contributions and voluntary after-tax contributions by October 15 if you file a timely filed extension for your sole proprietorship. In other words, your Form 1040. So let's say you missed that April 15, 2026 setup deadline for tax year 2025. You're still going to be able to open the solo 401k plan so that you can make employer contributions and voluntary after-tax solo 401k contributions. You would have until October 15 of 2026, and you would have to make the employer and the voluntary after-tax contributions by that October 15 of 2026. If you're trying to make contributions for the prior tax year, which would be tax year 2025, you would not be able to make employee contributions, however, if you did not open that solo 401k plan by December 31st of 2025 or by April 15 of 2026. So I know I'm throwing a lot of rules at you, but hopefully you'll have time to digest those regulations. Now, now we just talked about a sole proprietorship, the solo 401k setup deadline for business tax as a sole proprietorship. Now let's talk about S corps and partnerships. So unlike a sole proprietorship where you have more time to wait to open that solo 401k plan so that you can make employee contributions, with an S corp and partnership, if you want to be able to make employee contributions for tax year 2025, you're going to have to set up the plan by December 31st of 2025. If you wait to set up that plan until January 1st of 2026 and after, by the S corp or partnership tax return due date plus timely filed extension, so that would be March 15 of 2026 or September 15 of 2026 if you file an extension for that business, then you're only going to be able to make employer contributions and or voluntary after-tax solo 401k contributions for tax year 2025 if you wait to open the solo 401k plan in 2026 by March 15 or September 15. So in short, if you want to be able to make all contribution types, including employee contributions specifically, you need to open that solo 401k plan by December 31st of 2025. Otherwise, if you wait to do it next year in 2026, you're only going to be able to make employer contributions and or voluntary after-tax solo 401k contributions in 2026 for tax year 2025. So keep in mind that setting up the plan or opening the plan by December 31st of 2025 is much simpler than you may think. In short, you simply need to sign the plan documents, such as the adoption agreement. So under the IRS regulations, it's when you receive and sign the plan documents that determines when the plan is effective. So if you sign the plan documents by December 31st of 2025, then your plan is effective for 2025. As a result, you can wait till next year in 2026 to make all contribution types: employee contributions, employer contributions, and voluntary after-tax contributions. So you can wait to open up the bank or brokerage accounts, aka the holding accounts, for the solo 401k plan next year in 2026, as well as obtain the employer identification number for the solo 401k. So when you open the bank accounts or brokerage accounts in 2026, you're going to be able to make employee, employer, and voluntary after-tax solo 401k contributions if you sign the plan documents by December 31st of tax year 2025. So it's not when you actually open the accounts and make the contributions with regards to the deadline. It's when you sign the solo 401k documents that determine when the plan is effective, so that then you can make contributions by the applicable deadline. All right, I think we've got some questions here. Let's pause and answer some of those questions, and then we'll pick back up where we left off here. So, what are the benefits of working with providers versus going and opening a solo 401k with Schwab or Fidelity directly? That's a great question. And we get that question on a daily basis. We actually have a lot of clients that start off with a solo 401k at Fidelity or Schwab, for example, and then they'll transfer that solo 401k plan to a solo 401k from my solo 401k financial. That's called a restatement. And of course, we have a lot of clients that open a plan with us for the first time. And we also have a lot of institutional clients. A lot of our clients have advisors. So the advisor will use our services. That's why it's called an institutional account, because then the client can hold his or her brokerage account funds on the institutional side at Fidelity, Schwab, or even Altruist. So let me send over a link that compares a solo 401k offered by my solo 401k financial versus one offered by Fidelity. I'm also going to send over a link that compares the solo 401k offered by Schwab versus my solo 401k financial, so that you can learn more about it. We've actually have done several webinars on these topics. So take a look at those links there. And also, at a high level, clients like to use my solo 401k financial over Schwab, Fidelity, Chase Bank, Wells Fargo, T. Rowe Price, the Census, many others, for various reasons. One reason is because our plan allows for the mega backdoor Roth strategy. So the mega backdoor Roth strategy is where you make voluntary after-tax solo 401k contributions to the solo 401k plan, and then you immediately convert those funds to the Roth solo 401k. If you look at the slide here, here's an example of a one participant plan. So the plan would be sponsored by the business. You're going to have to open up 3 separate brokerage accounts under the plan to hold each source of funds. So it's not 3 separate plans. It's 3 separate brokerage accounts. And our clients oftentimes use Fidelity or Schwab to hold the solo 401k funds for the plan that we offer. So yes, Schwab and Fidelity will both, even though they both offer their own solo 401k, they will provide what's referred to as non-prototype company retirement brokerage accounts for a solo 401k offered by my solo 401k financial that allows for the mega backdoor Roth strategy. So as an illustration here, we would help you open up the plan with us. The plan is a retirement trust, so it'll have its own separate employer identification number. You don't use your business or your social security number. The plan has its own separate EIN number. We then help you open up 3 separate brokerage accounts. So it's not 3 separate solo 401k plans. It's 3 separate brokerage accounts to hold each source of solo 401k funds. That is pre-tax solo 401k funds, Roth solo 401k funds, and voluntary after-tax solo 401k funds. So neither Fidelity nor Schwab will provide a solo 401k that offers the mega backdoor Roth strategy. Well, one of the reasons people utilize my solo 401k financial over Fidelity or Schwab and those other institutions I mentioned is because our plan allows for the mega backdoor Roth strategy, and it requires having a separate brokerage account to hold those voluntary after-tax solo 401k funds. You then convert those to the Roth solo 401k. You then complete our online conversion form, and then we issue a Form 1099-R to the IRS to report that conversion known as the mega backdoor Roth conversion. Another reason individuals use a solo 401k from my solo 401k financial versus a Fidelity or Schwab is because our plan allows for solo 401k participant loans where you can borrow 50% of your solo 401k balance, not to exceed $50,000, and you borrow from your own self and you pay back. You borrow from your own solo 401k and you pay back your solo 401k with interest and principal. So those payments would flow back to the solo 401k. Another reason why individuals like to use my solo 401k plan versus a Fidelity or a Schwab or any other company I already mentioned is because our plan comes with a $1,500 auto contribution credit. The Fidelity plans and the Schwab plans don't come with a $1,500 auto contribution credit. And with these auto contribution credits, the cost to open and maintain a solo 401k plan is practically free. So it's a $1,500 stimulus that basically it's a dollar for dollar credit, which reduces your taxable business income on a dollar for dollar basis. It's $1,500 that you spread out over a 3-year period. So $500 increments over 3 years for a total of $1,500. And you're not required to make contributions to qualify for the auto contribution credit. So even though it's called the auto contribution credit, you're not required to contribute to the plan in order to qualify. As a matter of fact, you can opt out of contributing and you can still contribute all the way up to the overall limit for the year, which is $70,000 for tax year 2025 if you have the required self-employment income to support that contribution. Because you can't contribute to the plan unless you have earned income. You also can't contribute more than you make in self-employment income. But again, the auto contribution credit is only available if the plan provider has that feature built into their plan along with the applicable schedules. Well, we were the first ones in the industry to offer such a solo 401k plan with that auto contribution credit when it first became available starting January 1st of tax year 2024. And what's great about this auto contribution credit is that it's also available to existing clients. So if you're a client of my solo 401k financial prior to December 31st of 2023, we can add this auto contribution to your credit now, and you'll be able to claim that $500 credit for a total of $1,500 and $500 increments for 3 consecutive years. We would just need to add it to your plan. So if you're a client of my solo 401k financial, we can add this feature. Let me send over a link and you can submit a support ticket to prompt us to add this to your existing plan if you're a client of my solo 401k financial. For new clients, we automatically draft a plan to allow for the auto contribution credit. Now, I just shared a support ticket there with you. Now, as far as more information on the auto contribution credit, you're going to claim that $500 credit each year in $500 increments for a total of 3 years. You're going to file Form 8881, which you attach it to your business tax return. We have a PowerPoint and a video walkthrough on that form as well. So that's another big difference of why individuals open a solo 401k with my solo 401k financial. Another big reason is that here at my solo 401k financial, we'll take care of the ongoing reporting for the plan as well. For example, when you perform the Mega Backdoor Roth Solo 401k strategy, which, as I touched on earlier, entails making voluntary after-tax solo 401k contributions and then converting it to the Roth solo 401k, a Form 1099-R has to be issued. Neither Fidelity, the bank, or Schwab will issue that Form 1099-R if you use them to hold the funds for the solo 401k that we offer. Here at my solo 401k financial, we'll issue that Form 1099-R and file a copy with the IRS at no additional cost. Same thing with the Form 5500 Easy, which is an informational return that applies once the market value of your solo 401k plan exceeds $250,000 in value. So when you determine whether or not that Form 5500 Easy applies, you have to add all of the funds in your solo 401k plan. So all the pre-tax funds, the Roth funds, voluntary after-tax funds, and all the investments. You have to add all those amounts together. When added together, that means that the total value of the plan is determined. And if it's when you add those amounts together, if the fair market value is greater than $250,000, then a Form 5500 easily needs to be filed. This is an example of a two-participant plan. If you have both spouses that work under the same business, for example, they can both participate in the same plan. So you would have to add up all of their balances in that plan, and if it equals greater than $250,000 or more in market value as at the end of the plan year, for example, December 31st, then a Form 5500 Easy will need to be filed with the IRS. And we here at my solo 401k financial, we'll file that for you electronically with the government at no additional fee. You just need to make sure that if you want us to perform those services, that you reach out to us, because we don't have access to your funds. And that's by design, because we don't need to have access to your funds in order to help you perform the required Form 1099-R and 5500 Easy reporting when applicable. That's probably why we have a lot of clients. That's because we don't need access to your funds, number one. Number two, unlike other providers out there, we let you choose where to hold your funds at. It's your money, so you should decide where to hold your money at. Some of our competitors will steer you to hold their funds at a bank that they might be receiving a kickback from, or they might have their own broker dealer, so they'll try to have you hold the funds there. Not here in my solo 401k financial. You get to choose where to hold the funds at. So great question. So those are just some of the differences. Hopefully that answers your question. All right, let's see if we have some more questions here. I own 100% of my S corporation. None of my employees want to participate in the company 401k plan. I also received W-2 from S Corp. Can I make 401k contributions for myself? No, you cannot. So you cannot open a solo 401k plan if you employ any full-time W-2 employees in your business who work 1,000 hours or more. So even if they don't want to, even if they choose to not participate in a solo 401k plan, that doesn't matter, because under the solo 401k eligibility regulations, you can only open a solo 401k plan if you're an owner-only business, number one. Number two, you do not employ any non-owner full-time W-2 employees, which means an employee who works 1,000 hours or more in the business. if you employ anyone who works 1,000 hours or more in the business who's a W-2 employee, and if that individual is not an owner in your business, then unfortunately, you would not be able to open a solo 401k plan. Take that, let's discuss that one step further. Even if you own another business that's just you still would not be able to open a solo 401k plan because of the IRS aggregation control group regulations, where the regulations look at all of your businesses. And if any business under your control employs any non-owner full-time W-2 employees who work 1,000 hours or more, you won't be able to open a solo 401k plan. So good question. Now you can exclude those who are under age 21, even if they work 1,000 hours or more as a W-2 employee. But if you employ someone who's age 21 or older and that individual is not an owner in your business, number two, he or she works 1,000 hours or more in your business as a W-2 employee, then you would not qualify to open a solo 401k plan. But you can exclude those who are under age 21, regardless of how many hours they work. Okay, let's see here. What kind of plan I need to set up and what are the fees? Well, I mean, you'll want to talk to your advisor as far as to what kind of plan you want to set up. But if you're asking about setting up a solo 401k plan, then if you qualify, you can open a solo 401k plan with my solo 401k financial. And you would go to our sign up page and click on open account and provide the necessary information, and we would shepherd you through the setup process. But as far as what kind of plan to open, you need to discuss that with your financial advisor. But here at my solo 401k financial, we offer solo 401k plans. Okay, let's see here. Another question here. Can you allow for a mega backdoor Roth between after-tax to personal Roth IRA? Outside solo 401k once the contributions are made to the voluntary after-tax? Yes, you can. So with the voluntary after-tax solo 401k contribution, which is part of the mega backdoor Roth strategy, you have the option. You can convert those voluntary after-tax solo 401k funds to the Roth solo 401k, which most individuals do, or you can convert it to the Roth IRA. It used to be that those that were age 73, which means that they were required to process a required minimum distribution, those individuals would convert it to the Roth IRA instead of the Roth solo 401k, because Roth solo 401k plans used to be subject to required minimum distributions. Well, not anymore. With the passage of Secure Act 2.0, Roth solo 401k plans, just like Roth IRAs, are no longer subject to required minimum distributions. So for that reason, the majority of individuals will convert it to the Roth solo 401k instead of the Roth IRA. But yes, you can convert to the Roth IRA or to the Roth solo 401k. All right. Here's a question here. If I want to use auto contribution future, what does that entail? Well, yes, you can make automatic contributions to the solo 401k plan. You'll just need to link your business bank account to the solo 401k bank or brokerage account so that you can make contributions electronically, and that would be done on your business bank side, and the funds will flow electronically to the solo 401k bank or brokerage account. All right, good questions. Another question here. Do you help clients with the paperwork to exclude employees who are under age 21? Yes, our plan is actually drafted to exclude those who are under age 21. So that's a very simple addition we would add to your plan to make sure that those who are under age 21 are excluded. All right, good. So let's continue here. Now, if this information is helping you feel more confident about your future, please take us 1 second to like and subscribe. It tells the platform that this content is valuable, which helps other solopreneurs like you to find it. Subscribing also guarantees that you receive notifications of all our crucial content that we deliver every day to help secure your retirement. Okay, go ahead and continue to type your questions over and we'll go over those as they come in. For now, let's continue with today's topic, which is, does a solo 401k have to be set up before year end? And we've been talking about this at great length already. So we talked about how it depends on whether your business is taxed as a sole proprietorship versus a S corp or partnership. We talked about how the passage of Secure Act 2.0 allows for employer contributions and voluntary after-tax solo 401k contributions to be made, even if you wait to open your solo 401k plan by your business tax return due date plus timely filed extension, but you would not be able to make employee contributions unless you open that solo 401k plan by December 31st. We talked about the eligibility requirements to open a solo 401k plan. So some final thoughts about the solo 401k setup deadline. Again, you want to understand that it's driven by your self-employed business entity type. In other words, how your business is taxed. And it's best to act by December 31st to open the plan. So that way you can have a happy new year and not have to worry about it in next year in 2026 to make sure that you open it at that time so that you can make some types of contributions. Looks like we have another question here. Let's take a look at that. So here's a question here. If annual income from side business S corp is around 30,000, can we contribute 70,000 each for owner spouse from other income source like job after-tax funds towards pre-tax, Roth, voluntary after-tax accounts? Say like S corp wages of 25,000 each spouse, owner, and 23,500 going into S corp for solo 401k pre-tax. The remaining 46,500 funds coming from other jobs from owner spouse, each going to voluntary after-tax for a sum of $140,000. So keep in mind that contributions to the solo 401k plan have to be based on your earned income from self-employment activity. You cannot make contributions to a solo 401k plan based on your investments, so investment income, capital gains income, nor can you use your W-2 wages from your daytime employer. It has to be based on your net self-employment income from your business. So if your self-employed business is taxed as a S corporation, for example, then contributions to the solo 401k plan will be based on your W-2 wages from your self-employed S corporation business. What is more, if both of you are self-employed in the same self-employed business, both of you meaning both spouses, then it's going to be just one solo 401k plan. You're each going to have you're each going to have separate holding accounts for each source of funds under the solo 401k plan. And that's an IRS regulations that you have to have separate holding accounts for each participant in each source of funds because a solo 401k is a defined contribution plan. Now, if you each want to contribute to the solo 401k plan, you're each going to have W-2 wages, separate W-2 wages from your self-employed business S corp. So let's say one spouse pays herself $70,000 of W-2 wages from the S corp. Then let's say your spouse's name is Sally. Then Sally can make a voluntary after-tax solo 401k contribution to the plan of $70,000, and then immediately convert that to the Roth solo 401k plan. Sally can't make any more contributions because the overall limit for tax year 2025 is $70,000 for someone who's under age 50. Even if you're age 50 or older, where you can make a normal catch-up contribution of $7,500, or if you're age 60, 61, 62, or 63, where you can make a super catch-up contribution of $11,250, that normal catch-up and that super catch-up contribution can never be made as a voluntary after-tax contribution. Voluntary after-tax contributions are only allowed up to the overall limit of $70,000. But you are able to make that super catch-up or normal catch-up contribution to the Roth Solo 401k bucket, for example. But you're going to have to pay yourself more than $70,000. So Sally is going to have to pay herself, let's say she's age 50, 52. Then Sally would need to make at least $77,500 of W-2 wages from that S Corp. She would contribute $70,000 to the voluntary after-tax solo 401k bucket and convert it to the Roth Solo 401k. And then the catch-up amount of $7,500, Sally would contribute that directly to the Roth Solo 401k bucket. So you got to have the necessary earned income from your self-employment activity, not your day job or other outside income like passive income, investment income, and so forth. That's not allowed. It's got to be based on self-employment income for the year. Now, so that's Sally. Let's say your name is Jake. So if Jake also pays himself $70,000 of W-2 wages from his S Corp, then he could contribute $70,000 to the Solo 401k, convert it to the Roth Solo 401k. Now, that's one scenario. Now, what's great about the voluntary after-tax scenario that I just gave you here is that even if you contribute to your daytime job 401k and you maximize that daytime job 401k, let's say you contribute $50,000 or you contribute all the way up to $70,000 to that daytime employer 401k in combination with that daytime employer's employer contributions, you're still going to be able to maximize your mega backdoor Roth strategy because voluntary after-tax solo 401k contributions are never impacted by your daytime employer's 401k contributions. So we have a lot of clients that put $70,000 in their daytime job 401k made up of contributions that they make to it along with the contributions that their employer make. And then they also utilize the mega backdoor Roth, where they make $70,000 voluntary after-tax contribution and convert it to the Roth Solo 401k. So talk about really supercharging your retirement account. Of course, again, you have to have the necessary self-employment income to justify that contribution. It cannot be based on your personal investment income, your personal savings, your capital gains from your real estate holdings, whatever, stocks. It's going to be based on earned income from your self-employed business. Now, I gave an example of maximizing voluntary after-tax contributions. You can also choose to make some employer contributions and some voluntary after-tax contributions. Of course, between the two, you can now go over that $70,000 overall limit. So you're not going to be able to contribute $70,000 to your solo 401k voluntary after-tax bucket as part of the mega backdoor Roth, and then make another $25,000 as a employer solo 401k contribution. That's not allowed because you cannot contribute more than the overall limit, which is $70,000. So in sum, you can chop up that overall limit into the various sources, but there are different rules that apply to each source. And we've done webinars on this topic. Again, if you subscribe to our channel, you can view, we've done over 1,000 webinars. You can view all our webinars, and we have specific webinars to this topic and many other topics. So good question. All right. So here's another question here. Can Roth 401k contribution basis be withdrawn tax and penalty free like a Roth IRA contribution? So Obviously, the Roth IRA has different regulations, which you can learn about by visiting IRS publication number 590A and 590B. Whereas a solo 401k has different regulations, which you can find out more about regarding those rules under IRS publication number 560. So the distribution rules for a solo 401k plan are based on IRS solo 401k rules, which means that if you're trying to take a distribution of Roth solo 401k funds, you have to be age 59 and a half or older if we're referring to a contribution that you made as an employee Roth solo 401k contribution. Now, we've done a separate webinar on this topic, so I don't want to get too deep in the weeds and really confuse you. Now, if you're trying to make a distribution of an employer Roth solo 401k contribution, because under Secure Act 2.0, now you can make employer Roth solo 401k contributions as well. Well, those have their own distribution rules. So if you've had those employer Roth solo 401k contributions in the plan for 5 years or longer, you can distribute those employer Roth solo 401k contributions. So it's based on whether it's an employee Roth solo 401k contributions versus an employer Roth solo 401k contribution. You also have to be aware of the qualified versus non-qualified Roth solo 401k distribution rules, which has to do around having to pay taxes or not. Because keep in mind, the purpose of a Roth solo 401k is to grow those funds tax-free. Otherwise, you would make them as pre-tax contributions, but if you want those funds to grow tax-free, that's why you utilize the Roth solo 401k. So if you want to take a qualified distribution, which means you're not going to have to pay a 10% penalty or federal taxes on those earnings, then you have to meet two rules. You have to have had the Roth solo 401k portion, so this bucket here, for 5 years, and you have to be age 59 and a half or older. Otherwise, if you take a distribution before you meet those two rules, you're going to have to pay a 10% penalty if you're under age 59 and a half, and you're going to have to pay taxes on the gains. And you have to distribute on a pro rata basis when you take distributions from a Roth solo 401k. Now flip over to the Roth IRA. Roth IRAs have their own set of distribution rules. With the Roth IRA, you can always distribute the contributions that you make to the Roth IRA first. That's called the basis. So if you made a Roth IRA contribution of $7,500, you can always distribute those funds tax and penalty free and without having to pay a 10% penalty if you're underage, if you're under age 59 and a half, because the Roth IRA rules allow you to distribute contributions at any time. Now the earnings on a Roth IRA, those have different rules. I'm not going to get too deep into that, but there's also another Roth IRA distribution rule where you've got individuals that will transfer, let's say, a Roth solo 401k or a former employer Roth 401k to the Roth IRA. Well, those have their own distribution rules under the Roth IRA as well. Same thing when you convert voluntary after-tax solo 401k funds to the Roth IRA. That's going to have its own distribution rules under the Roth IRA. So again, we've covered this topic in other webinars. I can do an hour presentation on that, but today's topic is not that. But take a look at our YouTube channel where we have a lot of webinars on that topic. So thanks for that question. All right. That's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so that we can keep building this community. We'll be back here again in a couple hours, as a matter of fact, to go over some more information. In the meantime, take a look at our YouTube channel Take a look at our My Community, where we have over 30,000 members, where you can review forums, you can post forums. We have a lot of guest blog posts out there that financial advisors, CPAs, real estate professionals have posted. And if you're any of those professionals, you can post blog posts there so that you can shed light on your services. You can link that blog post back to your website so that the 30,000 plus eyeballs can see what services you offer, and they may even reach out. Okay, thank you again and have a good rest of the day.